Evening Supermicro Computer released their earnings statement, their 10K, that they were supposed to have delivered, I guess it was last July. The last one I think they delivered was in June. And so I decided, since I had done 5 videos last week, trying to get to the bottom of it and emphasizing the most important step was, were they going to make the filing of their 10K or weren't they? I needed to go and look at it and come to understand it. So here it is, and I've copied it. It's actually 277 pages of information. My Word document tells me it's 118,644 words. So what I wanted to focus on was, how did their books change from 2022, 2023, 2024. And so I found their consolidated statement on here and went through the numbers and made some judgments and copied the numbers and then took them and loaded them up into my ChatGPT. And between Samantha and I, we broke it down so that we could understand what this 277-page document was trying to hide. Okay, because I know the reality is that most people aren't going to do this. And so what you're going to do is watch and see what the market does. And overnight, it looks like the stock's going to be up 25%, or at least that's what the market said. Well, they made their filing, so it must be good. Well, let's dig in and see if it is in fact good, and see what I've been able to ascertain from my use of ChatGPT to analyze the numbers. So this is the document that Samantha and I generated, going through the financial highlights of their 10Q and coming to some conclusion. And what you initially see is that their cash and cash equivalents grew at about a 4x rate. Their cash and cash equivalents were in 2023 $440 million, and it grew to 1.67 billion, which shows, as Samantha said, indicating strong liabilities. The next line tells me, but their accounts receivable went up sharply, almost double. That is, from 1.15 billion to 2.73 billion, which indicates strong sales, but a potential for collection problems. And I don't know. All I can do is look at this and say, well, maybe some of the people who received the goods said, hey, they aren't going to be in business in 2025, so let's don't pay them. I don't know that, but it looks suspicious. Inventory surge. At the same time that people weren't paying them, their inventory grew by almost, what is that, three and a half fold, from 1.45 billion to 4.33 billion. And again, we know from last week's videos, a lot of people made switches. They went to Dell, they went to Hewlett Packard, and this is probably why this increase, because again, there was a shadow hanging over them, and until that shadow is removed, there is a reluctance on some people's part to do business with them. Now, their accounts payable increased significantly from 776 million to 1.47 billion. We learned what that was last week. That was convertible notes that they took out to the tune of 1.7 billion, new convertible debt that could end up diluting the shares. Their total liabilities, and this is relating it to your household, this is what you owe people. It went from 1.7 billion to 4.41 billion. How do you feel about that? I'd have problems. Shareholders' equity, of course, went up because those debts show up as equity within the company, because the company is holding the cash or spending the cash on new equipment and new buildings. Public stock holders holdings raised by $2.3 billion. That we'll get later into what that interprets or translates into shares. Their revenue and profitability surged. The revenue surged from 7.12 billion to 14.9. That's more than a double. And again, you got to recognize that revenue comes from numerous sources, sales of goods, but it also includes incursion of debt, or buying of getting convertible bonds that convert into stock. Net income went up, doubled from 6.39 to 1.15, showing strong earnings, and the earnings per share reflected that. Basic earnings per share from 121 to 207. These are all good things. Gross margins improved from 1.28 billion to 2.6. So what they sold, they got a good price for. In fact, a better price than they did in 2023. But as we saw up above, some of these people didn't pay. The margins appeared on the books, but they didn't pay. Research and development spending moved up slightly from 307 to 463. S&GA increased at a lower rate, demonstrating efficiencies. This is the expenses that are associated with the goods that they're selling. Cash flow concerns. Operating cash flow was negative, 2.49 billion, versus positive 663 million in 23, maybe due to inventory buildup and accounts receivable. So what that's saying is they didn't have near the money coming in, even though, if you remember, the revenues were outstanding. They didn't have the money coming in that they had in 2023, even though sales were up and creating some red flags. Rapid inventory buildup, 200% increase in inventory suggests that they're stockpiling components, or because of their accounting problems, some people said, we're going to buy from Dell, we're going to buy from Hewlett-Packard, and so their inventory grew. And is it a red flag that demand is slowing down? Negative operating cash flow of 2.49 billion. We talked about that. They're going through a lot of cash burn, and the risk is that it's unsustainable growth model with this cash burn. Significant amounts of receivable growth. We talked about that earlier, that their accounts receivable has gotten up to $2.73 billion. And again, is it bad debt, or is it people saying they're not going to be in business after the March the 1st of 2025, so we just won't pay them, and now they're probably going to have to pay them. Convertible debt, stock dilution is an issue we got to be concerned about. Stock dilution risk. They issued, as it said earlier, $2.3 billion in new shares, and that represented, as you see here, from 529 million shares to 588 million in 24. So if you've got a share, it's not worth it as much as what it is. And then the other element of this, as we covered in our videos last week, is there is a lot more debt on the books that are convertible notes, which could also turn into even more shares. And as we covered in the video last week, they have, rather than about a 2.3 billion, they have some debt, convertible shares, that amount close to 4 billion, which would turn into, at the redemption price, close to $8 billion in new shares coming in, which is a substantial dilution of shares. So what, as investors, do I recommend you do? First of all, monitor inventory turnover. We have to pay attention to any documents that they put out for future earnings. We have to go through any press releases that they might put out or any other filings that they may have to make to see if this inventory turnover problem is taken care of itself, if the cash flow starts to become positive rather than negative, and if future debt issuance may be needed. If we see that they're having to borrow more money, they've got an issue. Be aware of dilution risk. We've talked about that. Assess consumer payment cycle. We got to watch to see if these accounts receivable are going away. For clients, we're not a client, so we're not going to worry about that. My take is that this is the kind of information we need in this day and age to when someone files a 10Q that consists of 500 or 277 pages. There's too much for most of us to digest. So rather than do this on your own, I suggest you come together as a team, a community. That's what I like to call it. Our tribe is a community. And I do this kind of work. I get the help from my tribe, my 1,000 people who subscribe and feed me information. And then I put it together and disseminate it out in a format that can help you make better investment decisions. This is all available on our Gold platform. We put it up for $19.95 a month, and I think it can make you a better investor. It can give you more information, and that's the difference between a winner and a loser in this game we're playing. The one with the most information, that has access to the data, knows how to interpret the data and then to present the data and make good investment decisions. So take a look at it. And if I can help you, I want to.